CECO Environmental absolutely crushed Q2 2026 consensus estimates today.
Oh, totally crushed them.
Right. I mean, adjusted EPS came in at 47 cents. That is blowing past the street's expectation of, was it 24 to 33 cents?
Exactly. You were looking at a near 42% beat on the bottom line right there.
And the top line is just as wild. Revenue hit $285 million.
Which is a massive 53.7% year-over-year increase.
Yeah, easily clearing the 279 to 282 million consensus.
Yeah.
And, management didn't stop there. Based on these numbers, they actually raised their full year 2026 consolidated outlook across the board.
Yeah, the revenue target is now 1.30 to 1.375 billion, bumping that floor up from 1.275.
And adjusted EBITDA got bumped up too, right?
Right, to a range of 200 to 225 million.
So the market reaction was exactly what you would expect for a beat and raise of this magnitude. The stock surged like 7 to 8% in pre-open and early trading.
Makes total sense.
But, and this is a massive, but if you pull up the actual 10Q right now, rather than just reading those non-GAAP headlines, you are going to get severe whiplash.
Oh, absolutely. I mean, it is the classic tale of two income statements.
Yeah.
Because on paper, if you don't know the mechanical backstory of what happened this quarter, these look like two completely different companies reporting earnings today.
Right, because while the adjusted numbers look flawless, the GAAP bottom line is glaringly ugly. I mean, imagine buying a house, adding this massive new wing that increases its value by 50%, and then your accountant tells you that you were suddenly broke.
Yep, that's exactly it.
That is exactly what CECO Environmental's Q2 earnings look like on paper. We have this massive non-GAAP beat on one side, but a shocking GAAP loss on the other. Walk us through how you reconcile this massive discrepancy.
Well, the GAAP numbers require a strong stomach if you aren't prepared for what's actually happening under the hood.
For sure.
Despite the massive non-GAAP beat we just led with, CECO actually posted a GAAP net loss of $34.8 million for the quarter.
Wow.
Yeah, that translates to an 80-cent loss per share. Compare that to the, the $9.5 million of net income they posted in Q2 of 2025, and you see this violent, severe swing into the red.
An 80-cent loss per share when the street was expecting a profit is, that's the kind of headline that usually triggers a massive sell-off.
Oh, 100%.
So we have to explain the actual culprit here, because the top-line growth is obviously there, and really this all comes down to the June 1st closing of the Thermon Group Holdings acquisition.
Correct. When you swallow a company of that size, the accounting immediately gets incredibly messy.
Yeah, I bet.
GAAP accounting treats buying a massive company like swallowing a watermelon whole.
That's a great way to put it.
Right. Your body, meaning the underlying business operations, might be perfectly healthy and operating at a really high level. But your system, in this case the income statement, is going to look violently sick while it tries to digest the transaction.
Because of the immediate upfront cash outlays that, they just don't reflect the daily operations of selling industrial equipment.
Exactly. I mean, CECO booked $45.5 million in acquisition and integration expenses just in this quarter alone.
$45 million.
Yeah. When you take a $45 million charge straight to the income statement, it completely obliterates your GAAP profitability.
Regardless of how well the legacy business did.
Right, regardless of how well the underlying business performed in those 3 months. You are paying investment bankers massive advisory fees, you're paying legions of M&A lawyers, you are paying out severance packages to redundant executives, and you are eating immediate restructuring costs.
But seeing endless, quote-unquote, adjustments quarter after quarter starts to look like a convenient rug to sweep bad operational health under.
Sure, it can be.
Well, I know you're looking at the $45.5 million as a one-time ring-fenced M&A cost, but as a retail investor, you have to wonder if this non-GAAP adjustment is masking a business that is structurally deteriorating.
It's a fair question.
Like, are they actually digesting the watermelon, or is it getting stuck? How do we know these aren't just ongoing operational failures disguised as integration costs.
Well, it is a vital skepticism to have, and it is exactly why you have to look past the net income line and dig into the operational metrics.
Okay, so where do we look?
If you want to know if the foundation of this newly combined entity is actually solid, you look at adjusted EBITDA and you look at margin expansion.
Because EBITDA strips out the noise.
Exactly. It strips out taxes, interest, and those one-time accounting charges to show you what the actual cash-generating engine of the business is doing.
Right.
And both of those metrics paint a picture of very robust operational health right now. Adjusted EBITDA didn't just inch up, it soared 73% to $40.2 million.
Which significantly outpaces that 53.7% revenue growth we talked about at the very beginning of the deep dive.
Right. And that math means margins are expanding.
Okay?
Adjusted EBITDA margins expanded by 150 basis points to hit 14.1%. That is the crucial takeaway here.
So they're getting more efficient.
Yes, they are extracting more profit from every single dollar of revenue they bring in, even with the newly acquired Thermon assets in the mix for just 1 month of the quarter.
Let's talk about how they are actually doing that, though. Because the most compelling defense of these being true one-time integration costs is the synergy realization.
Oh, absolutely.
Management reported they have already captured $13 million in annualized EBITDA savings. And that's in just the first 60 days post-merger.
Yeah, that speed is incredible.
It's highly unusual in the industrial sector. How do you actually extract $13 million that fast?
You hit the low-hanging fruit with a sledgehammer from day one.
Okay, paint a picture of that.
Well, their stated synergy target for the entire Thermon acquisition was $40 million. Hitting 1/3 of that in 60 days means they went into the merger with a very aggressive integration playbook.
Right.
Mechanically, this looks like immediately consolidating enterprise software licenses. It means eliminating duplicate corporate functions. You don't need 2 HR departments, and you certainly don't need 2 accounting teams to run the combined entity.
Right, so the severance packages we mentioned earlier that were driving the gap loss, those are the exact mechanism creating this future margin expansion.
Bingo.
You paid a redundant director 6 months of severance to leave today, so you don't have to pay their salary for the next 10 years.
Precisely. And they are likely also realizing immediate supply chain leverage.
How so?
When you combine CECO and Thermon, your purchasing power for raw materials suddenly spikes. You go to your steel and component suppliers and say, look, we are now buying significantly more volume across our entire portfolio.
So we need a discount.
Exactly. We need a volume discount across the board. So the $45.5 million gap hit is the painful upfront cost of renovations, but the $13 million in immediate annualized savings proves the transaction is already yielding a leaner, higher-performing asset.
Okay, so the cost side is being actively managed, but a more efficient operation is only valuable if you have the demand to put through it.
Oh, totally.
Like, you can build the most efficient industrial plant in the world, but if nobody is buying your exhaust systems or thermal solutions, you are still going to go bankrupt.
Yep.
And this is where I think the Q2 report becomes truly staggering to digest.
Yeah.
Because the forward-looking indicators here are arguably more impressive than the revenue beat itself.
I would actually argue they are significantly more impressive.
Really?
Yeah, Q2 orders skyrocketed by 191%
Wow.
to $798.5 million.
Yeah.
That is a massive influx of new business in a single 90-day window.
Just to put some context around the sheer scale of that number for you, the trailing 12-month book-to-bill ratio is now sitting comfortably over 2.0.
It's huge.
And for this quarter alone, the book-to-bill was approximately 2.8. Now, if you track the industrial sector, you know that anything consistently over 1.0 means you are growing.
Right.
A book-to-bill of 2.8 means for every single dollar of revenue you recognize today, you are stuffing almost $3 of future revenue into the pipeline.
Exactly.
Consequently, the backlog expanded by 164% to a record $1.82 billion. But we need to explore why this is happening. Where is all this demand actually originating from?
Well, that $1.82 billion backlog is the ultimate security blanket, but the origin of this demand is what validates the entire M&A strategy in the first place.
Right.
It's not just a general macroeconomic uptick. It is highly concentrated in booming industrial supercycles. They are seeing intense order intake in power generation, specifically large-scale natural gas projects. They are winning major contracts in semiconductor manufacturing manufacturing, industrial water, and broader infrastructure markets.
And the power generation piece makes total sense when you look at the energy transition supercycle.
Oh, absolutely.
The grid simply cannot support the modernization of infrastructure with just wind and solar alone. You have to build natural gas facilities to stabilize the baseload power.
Right, you need that reliability.
And when you build a massive natural gas plant, you need massive environmental control systems to scrub the emissions and handle the exhaust.
Ah.
That falls right into CECO's lap.
Exactly. And the semiconductor story is very similar. The onshoring of semiconductor manufacturing is driving billions of dollars in domestic fab construction.
Right, the CETPS Act and all that.
Yep. And semiconductor manufacturing is an incredibly highly regulated, chemically intensive process. You need sophisticated air pollution controls, specialized exhaust handling, and ultra-pure water systems to even operate a fab.
But wait, how much of this specific order intake is legacy CECO versus the new Thermon capabilities? Because if CECO was already going to win these semiconductor and natural gas contracts, why do they need to take on the headache of buying Thermon at all?
That goes straight to the strategic rationale of the acquisition playing out in real time.
Okay, unpack that.
Thermon directly expanded CECO's thermal solutions segment. Before the acquisition, CECO might go into a new semiconductor fab project and pitch their air pollution control equipment. That's a great contract.
Sure.
But now they can walk into that exact same fab, pitch the air pollution controls, and then cross-sell Thermon's thermal management solutions, like industrial heating and freeze protection for critical piping to the exact same customer.
Oh, so you are capturing a significantly larger share of the wallet without having to acquire a new customer.
Exactly.
The sales team is already in the building, dealing with the same procurement managers.
Right. They are leveraging their existing geographic footprint and their established engineering relationships to double dip on these high-growth end markets. It makes the combined company an essential one-stop shop for environmental and thermal management on these mega projects.
Okay, but let me throw some cold water on this, because on the earnings call, management cited a sales pipeline exceeding $8.5 billion.
Yeah, that's a big number.
Now, 1.82 billion in backlog is a hard audited number on the balance sheet, but an 8.5 billion pipeline. As a retail investor, you hear pipeline, and it is very easy to conflate that with guaranteed future revenue.
Right.
But this feels a bit like, pie in the sky, corporate speak designed to hype up the stock. How much of that 8.5 billion is actually real?
It is a critical distinction to make, and you have to separate the two concepts mechanically. An $8.5 billion pipeline is essentially the total addressable market of specific projects they are currently bidding on or tracking globally. It is a measure of market opportunity, not secured revenue. A lot of that $8.5 billion is going to be won by competitors.
Right.
Some of those projects are going to lose funding, get delayed by permitting issues, or get canceled entirely before ground is even broken.
It's the top of the sales funnel. It's the universe of maybe.
Exactly. It's maybe. However, the $1.82 billion backlog is the absolute bottom of the funnel.
The yes universe.
Right. That consists of secured purchase orders associated with active funded projects. These are legally binding commitments.
Got it.
And management was very explicit on the call. They expect the vast majority of this $1.8 billion to convert to realized revenue within the next 12 months.
Wow, that fast.
Yeah, this isn't a backlog stretching out to 2030. It is near-term, highly visible revenue that directly supports their raised guidance for the second half of the year.
So a massive near-term backlog is a fantastic problem to have, but building out $1.8 billion worth of industrial equipment isn't free.
Not at all.
Executing a backlog of that magnitude requires serious capital. You have to buy the raw materials, you have to procure the specialized components, and you have to fund the working capital cycle.
Yeah.
Meaning you pay your labor and suppliers months before the customer actually pays you for the finished product. Which brings us to the balance sheet. How much cash do they actually have to pull this off, especially under the weight of the Thermon acquisition?
This is where you need to pay very close attention to the risk profile, because the balance sheet has fundamentally transformed over the last 90 days.
Okay, let's hear the damage.
To swallow Thermon, CECO had to take on significant leverage. Gross debt increased by approximately $523 million since the end of 2025.
Over $500 million in new debt.
Yeah.
right as interest rates remain historically elevated.
Yes. That pushes their leverage ratio currently to 2.7 times trailing 12-month bank EBITDA.
Ouch.
Yeah, that is not an insignificant debt load for an industrial company entering a massive execution phase where cash needs are incredibly high.
And when you look at the cash flow, the GAAP numbers flash another glaring warning sign.
Right.
GAAP free cash flow was negative $24.3 million for the quarter. So let's connect these dots. You have negative free cash flow combined with a massive $500 million jump in debt, all while trying to fund a record backlog.
It looks scary.
It looks like a textbook red flag for an imminent cash crunch. You have $1.8 billion in orders to fulfill, but you are bleeding cash. How are they going to fund the operations?
Well, if you stop your analysis at the GAAP free cash flow line, it absolutely looks like a looming liquidity crisis.
Hi.
But we have to apply the same logic here that we applied to the net income line with the watermelon analogy.
Okay, the M&A noise.
Exactly. We have to strip out the noise of the M&A transaction to see the cash generation of the actual business.
Okay.
If you remove the one-time cash payments directly related to closing and integrating the Thermon transaction, which means subtracting the actual checks written to the bankers, the lawyers, the severance payouts, and the restructuring costs, the adjusted free cash flow is actually a very healthy $53.2 million for the quarter.
Okay. So
Wow.
the underlying business operations are actually generating over $50 million in cash.
Yes.
But because they had to write roughly a $75 million check in one-time fees to close the Thermon deal, it dragged the reported number into the negative.
Precisely. The core engine of the business is highly cash generative, and management is acutely aware of the leverage concerns. They know the market is watching that 2.7 times ratio.
They'd be crazy not to.
Right. So they are targeting a highly efficient free cash flow conversion rate of at least 55% of adjusted EBITDA for the full year.
Meaning for every dollar of adjusted EBITDA they generate, they plan to turn at least 55 cents of it into cold, hard cash in the bank after all capital expenditures are accounted for.
Right. And to prove they aren't just paying lip service to the debt load, CECO didn't wait until the end of the year to start deleveraging.
What did they do?
They already paid down $39.5 million of that new debt in July 2026, right after the quarter closed.
Oh, wow.
Yeah, they are prioritizing balance sheet health immediately to give themselves the breathing room to execute.
Okay, so the cash generation is there to service the debt, provided the backlog executes smoothly. But what could disrupt that smooth execution? Because in the industrial sector, a backlog is only as profitable as your supply chain allows it to be.
Absolutely. And management was very transparent about the macro risks they're monitoring, and this is where the execution risk truly lies.
What are they watching?
You must keep an eye on geopolitical conditions in the Middle East, general inflation, and raw material cost fluctuations. When you have a $1.8 billion backlog, your absolute biggest enemy is input cost inflation.
Let's walk through the mechanics of that, because it is crucial for understanding industrial execution. Let's say CECO wins a contract today to build a massive emissions control system for a natural gas plant.
Okay.
They price the contract at $10 million based on today's price of steel, today's copper prices, and today's shipping freight rates.
Yeah.
But the project takes 9 to 12 months to build and deliver.
Exactly. If raw material prices spike between the time CECO signed the contract and the time they actually buy the steel to build the equipment, their cost of goods sold shoots up.
But the revenue doesn't.
Right. The customer is still only paying the agreed upon $10 million, but CECO's internal costs just jumped significantly. Or if shipping routes in the Middle East are disrupted and freight costs double, that eats directly into their profit.
Yeah.
That dynamic will squeeze those newly expanded 14.1% margins very quickly if they don't have adequate escalation clauses built into their customer contracts, or if they haven't properly hedged their raw materials. Executing the backlog is only half the battle. Managing the supply chain to execute it profitably is the real test over the next 12 months.
So what does this all mean? Let's bring it all together. CECO Environmental is a company undergoing a massive, rapid transformation.
Sure.
Yes, the Thermon acquisition makes the current quarter's GAAP net income and GAAP free cash flow look incredibly ugly on the surface. But when you look under the hood and strip away the one-time integration costs, the underlying adjusted cash generation is robust.
Highly robust.
They're extracting cost synergies well ahead of schedule, and they are leveraging a record-breaking backlog driven by the massive infrastructure and energy transition supercycles. The foundation is solid, and the cross-selling strategy is clearly working to capture more market share.
It is a highly successful integration story thus far. But if we connect this to the bigger picture, there is a fascinating wild card we haven't touched on yet.
Well, what's that?
Antitrust scrutiny.
Ah,
CECO just effectively swallowed a massive target, immediately extracted synergies, and tripled their orders in the process. We are seeing this get big or get left behind mentality across the mid-cap industrial sector as companies try to aggressively bulk up to handle these massive infrastructure supercycles.
they need the scale to even compete for the billion-dollar fab and power plant contracts?
But exactly. But at what point does the FTC step in?
Right.
If mid-cap industrials continue to aggressively roll up their competitors to secure these mega contracts, we could see regulators argue that these highly specialized markets like industrial pollution control and thermal management are becoming monopolies.
That's a huge risk.
CECO proved they can swallow a massive competitor like Thermon and dominate the order book, but that very success might make future acquisitions exponentially harder to push past regulators.
Yeah, if the government decides the environmental control market is too consolidated, CECO won't be able to rely on M&A for their next phase of growth. They will have to rely entirely on organic execution.
Precisely. Or, conversely, are there new margins and massive pipeline making them an attractive takeover target for an even larger industrial conglomerate?
Well, that's an interesting thought. The renovated fixer-upper might just become the most attractive house on the block.
It really might.
It is a dynamic you absolutely have to watch closely as this sector continues to consolidate under the pressure of these super cycles. And if you want to cut through the noise and get the actual numbers that matter, make sure you are following the show for our daily earnings deep dives.